the logic. Okay, and this is for the crowd that's listening that love stochastic. Okay, I'm going to tell you how to use it and make money. Okay, you ready? What did you just say? Oh shit! Now you wait. I'll wait for you to get your pen and pad. Now you want to write shit down, right? Yeah, I'll give you a second. I gotta write this down. He's talking about indicators now. That's my shit. That's my jam. Now let's go back and go through the normal process of a normal, well-adjusted ICT student. We're looking at a weekly chart. We come to the conclusion that we expect that weekly chart to resume going up. Okay, it has unfinished business. It's an imbalance above price. It could be reaching up into, or relative equal highs, or a singular high it's gravitating towards. Is that complicated? Because it's going to be one or the other, or in the better condition, it's going to offer both. That means you have a real strong probability that the weekly expansion is going to be up. Doesn't mean we're trying to predict the weekly close. It just means that our focus should be primarily focused on a gravitation in price going higher. That means, bottom line is, we are trying to be a buyer going into the next week. Now go back to that premise of waiting for the market to open up. I abandoned buying strength because I learned that Larry Williams said that he wanted to understand how people could be a buyer below the opening price on big bullish days. And he was demanding that he see a 20% of the previous day's range be above the opening price for the S&P. And then he would be a buyer. To me, in hindsight, looking back at it, I discovered that I was many times buying on a 10 o'clock high, and then my stop loss that would be retracing down to a silver bullet that down today would be a new entry, or really a more sound entry if you didn't buy below the opening price. I would get stopped out there, and then what would happen? Think. I went long buying strength, then it retraces on me, my stop loss gets hit, or it scares me and I close the trade, but it goes into what you understand now is the fair value gap, which is a silver bullet. What's price going to do? Take off. I'm not in it. I'm demoralized. I'm angry. I'm upset. So I learned from that. I said, okay, I'm not going to wait for that retracement. I'm going to buy it as it drops underneath the opening. If I think it's going to go up, I want to find out where we open, and I want to see it drop down. So all I would do is use a 15-minute time frame, and whatever the low was, it was real close to going left. Whatever the first 15-minute low was, I don't care if it was 2 handles. That was what I needed it to go below. Once it did that, then I started buying it. In the beginning, it did not work well. It was me going in and losing lots of money doing that. I would go in and I would condition myself to say, okay, I'm going to figure this out because he says he wishes he could learn this. I'm going to learn how to do that. I'm going to learn how to do that. I'm not going to lose more money with something I can't replicate with him saying he's willing to do that. That was the biggest milestone in my development, by understanding that a mentor, like for all of you, you might have seen me do something, okay? And there's a lot of my students that are guilty of this. And I understand because I experienced it myself. When you have a hero that you look up to and you're trying to learn from, it doesn't need to be trading, to be anything. And they can do something that you try very hard to emulate and try to do as close as you can to what they're able to do, and you fail, it builds a certain measure of animosity. It may not manifest itself vocally or in a manner where other people can see it, but internally you feel it and you wrestle with it. I was angry at Larry Williams because I felt like he was teaching something incomplete when he really wasn't. His stop loss allowed for a lot of gross retracement that I, as a trader, was unwilling to absorb, and I didn't have the money to absorb it. So I had to create something that was inspired as a challenge. I took it as a challenge. He said he couldn't. Well, shit. At that time, I couldn't make 10,000 become $1.2 million a year. I couldn't do that then. I can do it next year, but that time I can't. So what am I going to do? I'm going to try to scratch the itch the best I can and start delving into an area where he said he can't do that. Okay, I'm going to try to do something that he said he can't, and I think he's Mr. Everything in trading. So I'm going to devote my time into that. And I lost a lot of money trying to figure out a system of determining, how far will it drop down? How far will it go down? And then I started looking for, you know, more than single swing lows, and I'd start seeing the two relative equal lows. And then I would look at the overnight Globex low, and then there would be this little tiny segment of price action where it was one candle, buy side imbalance, sell side inefficiency, resting right below relative equal lows. That was my banger. That was the one I wanted. That's the very setup that cracked the code for me that I figured out, okay, when that forms, I know that's the day that this is going to make the low right there in that fair value gap, which I didn't call it a fair value gap then, but it traded down into that. That would be my initiation to go in long, because what is it doing? It's knocking out stops. It's taking out a support level, and it's going into an inefficiency. So that's where it's going to go. So if I can get my order in to buy as it drops down in a time when I think the weekly chart is going to go up, what am I doing? I'm buying below the opening price. What opening price, ICT? I know some of you are like, you keep talking about the opening price. What the opening price are you talking about? Well, if I'm going to be up in the morning session trading the 9:30 opening, or if it was, the bond where I was trading the bonds, prior to equities opening, it's the opening price at the open outcry pit at the time, because back when I was trading in the 90s, we didn't have electronic trading. It was open outcry. So what I discovered was that when the market would create these buying below the opening conditions, which were highly primed to go up, I was in an area where I felt very, what's the word I'm looking for here? Empowered, because it was repeating a lot. And I knew I had something, and I wanted to still go back in and ring in the stochastic because it wasn't on my chart. And I felt like it would make it better if I did this. So I put the 10 period stochastic on an hourly chart back on my chart and use the same logic. It has to be oversold. And then once it becomes oversold, does that same idea of the opening price see that drop down? And the whole aspect of a Judas goat came to mind. That initial drop down when the market's predisposed to go up, that's what I dubbed it as a Judas swing. Now, it led me astray many times when I was trying to be a short seller because I was so excited about learning how to do short selling. I even got caught up in many times a Judas swing. So I had to relearn a lot of things and get my mindset corrected from those things because I was chasing something new, shiny new object syndrome. So I abandoned what I had already learned by what I just told you here. That's how quick and easy it is for you to derail yourself and forget all the progress that you just made. So it's important that you understand my departure from being on social media shouldn't be an invitation for you to just drop all progress and just say, that's it, I can't do it anymore because I can't be inspired. ICT is not here to encourage me when I am. Go back and listen to old Twitter spaces. It's the same thing as I'm saying it now. For some of you, you're going to be listening to this months from now. You're going to get the same thing. Everything I'm saying here is timeless, and it's available for people to make a model that's completely unique to yourself. There's enough information on that YouTube channel to take and build yourself something completely unique that no other student of mine is using. And you could have that as your model for the rest of your life and pass it on to your children. Never write a book about it, never teach it as a mentorship, never give signals on it, and be wildly profitable and happy. I would love to see that happen, But some of you are going to try to complicate this when I didn't complicate it myself. And you got to be very careful not to do that. Just because I have lots of things in my toolbox doesn't mean you got to bring every Phillips head and flathead screwdriver to the job that only requires a hammer. Yeah, you have to simply settle down and realize what it is that you're trying to do. Because strip down technical science real quick for me, ICT. Make it simple so that way I can grasp it. We're looking for a time, a period of 1 month, where the likelihood of the market to reach to a group of orders that are resting in the marketplace above the current market price. where would they be resting? Logically, it would be above a singular high or a swing high, or above relative equal highs that are in close proximity. The one that has the relative equal highs, that's going to take precedence over a singular high because the idea that it inspires resistance. Any inefficiency above price is a likely draw on liquidity. It's further compounded to likely if your weekly analysis is suggesting that it's going to try to gravitate up anyway. So now, what have you done? You've taken a stage where the market is predisposed by your analysis, and you can be wrong. How do I remove that? You don't. You're always embracing uncertainty as a trader. You are a manager of uncertainty. That's what trading is. That's it. You have no control of the outcome. You have no control of the absolute amount of drawdown or profit or the success or failure of your next trade. You can't control that outcome. You submit yourself to the likelihood that if it does this, I can profit this much. But if it does this, I stand to lose this, and it's okay. I can still be in the game, and it won't rattle me to the point where I am afraid to take another trade. That is a big balancing act. And so many of you discount that, thinking it's not going to be significant of a factor for you. When it is the very underlying factor that's keeping you to be successful. And you know it many times, but you keep pushing it aside and ignoring it and saying, no, I just need to find a better entry strategy. I need to know when it's a right shift in market structure. Fella, listen, okay, I see you tweeting to me. You have to spend more time on the higher time frames and understanding how to read the tape. And by doing that and spending more time watching real price action, you won't fall victim to market structure shifts that are either fake or actual. There's no shortcut to it. So it's just a matter of time studying the charts, okay? And some of the greatest lessons you're going to learn is when you start finding out that you're better as a trader when you have scheduled only 3 trades a week at maximum. I said week, not day, not session. Yeah, when you come to the realization that the best setups that you're looking for the week are only 2 or 3. Doesn't mean you can't make money doing all kinds of other shit, because you watch me do it and you watch my students do it. I'm saying the cream of the crop, the best, the choices, the medallion setups, 2 or 3 at most per week. You find them on the 4-hour. How often are you spending your time on that time frame? Until I started teaching actively around the weekly chart, you never even considered it. You're always looking at those 5-minute charts. It's 1-minute charts. Now the flavor is sub 1 minute. You know, those 1-minute charts ain't going to do a thing that ain't already determined on that weekly chart, on that daily chart, on that 4-hour chart, on that 1-hour chart, that 15-minute chart, that 5, and that 1. The storyline with all those time frames, what it should do, at what time it should do it, that's when those second charts are going to behave like you want them to. Otherwise, you're going to chase things that aren't really there.